Welcome to Financial Toolbox, a podcast series sponsored by CIBC Bank USA that understands that financial wellness is not innate, it's learned. Whether you're a member of the next generation wanting to start your financial journey out strong, or you're a lifelong learner looking to improve your financial standing moving forward, our team of experts are here to equip you with the information you need to help make your ambitions a reality. And now for this week's episode.
Hello, and welcome to Financial Toolbox. My name is Kevin Cahill, and I lead the business banking group for CIBC Bank USA. I'm pleased to be your host today, where we will discuss cash flow for small businesses. For this episode, we will discuss the effects of cash flow, and joining me today is Todd Gordon, who manages our business banking credit team here at CIBC Bank USA. Thanks for joining me, Todd.
Thanks, Kevin. Happy to be here.
All right, let's get started with you telling the audience a little bit about yourself and how long you've been in banking.
Yeah, so I've been in banking for close to 25 years. And so I've worked at a few different banks, seen financial statements of thousands of different companies and different industries, pretty much always in the small business and business banking space. But it's given me an opportunity to review many different financials and really understand a variety of industries and companies and see how they work. So I've seen what works and what doesn't, and I've seen successful companies fail, and then I've seen failing companies actually turn it around and succeed. So there's definitely some common themes of why and what parts of the credit side that drove that.
You know, as a bank, we probably look at small businesses up to, 30 million in revenue. When people mention cash flow, what does that mean to you?
Yeah, that's a good question. So, cash flows can be a confusing topic. So a lot of people confuse profitability with true cash flow or cash. And profitability is really only good if you can turn those profits into cash, because you're not going to be able to pay bills or buy inventory or pay expenses with IOUs, right? So to me, cash flow relates to the entire operating cycle. It's the money coming in, it's the money going out, and just making sure that you have enough cash to pay all of your bills.
Can we talk a little bit more about one of the points you just made? Walk us through why profits don't always mean cash flow.
Yeah, I mean, it's definitely all connected, but there's a lot of different layers to it. So profits are mainly on the income statement, and they show you what you should make and what you should have based on your sales, right? But to really understand cash and cash flow, you have to go an extra step and look at the balance sheet also. And so there's really three main components, I would say, on a balance sheet, right? There's the accounts receivable, there's the inventory, and accounts payable. And they really all work together. So starting with accounts receivable. For an example, if I sold 100 pencils at $1 each and they cost me 50 cents each, that would be $100 in revenue, $50 in the cost of those pencils. And so it would look like I made $50 profit. But then if you go at that extra step further, what if the people who bought the pencils can't pay me for 30 days? That makes an accounts receivable for the $100. So my income statement would show that I made $50, but in actuality, because there's that accounts receivable, I have $0 right now. Meaning as expenses come up, so those salaries, rent, things like that, I need to be able to collect that receivable to create cash flow so that I can pay my bills.
Can you explain how that would tie into inventory and accounts payable also?
Yeah, of course. So in that same scenario, right, if I had 100 pencils and sold them, now I need to buy more pencils so that I can sell more. But if I haven't collected those accounts receivable or those payments, I don't have any money to buy any more. So I don't have any more inventory to sell. So then if some suppliers were selling me those pencils, and they might offer what's called terms, right? So they may give me 100 pencils and say, you don't have to pay me for 30 days. that payment, what I owe those suppliers, creates an accounts receivable. But I still need to be able to collect the profits that I made and the payments from those customers that I sold to in order to make the payments on those payables, right? So when companies get into trouble is when their payments are due before they get paid, so they really don't have any cash to make their payments.
Got it. So everything is all connected, and really everything you do in business drives cash flow. But let's talk a little bit more about the balance sheet. So is there a specific way a balance sheet should look?
There is and there isn't. There really isn't a one size fits all. And so a balance sheet is really just a snapshot in time, so it can change on a daily basis. Like if you think about it, an income statement is more like a movie, right? Like it compounds over the course of a year. So it's January 1st plus January 2nd plus January 3rd plus January 4th. Whereas a balance sheet is more of a picture. So you will see a balance sheet as of January 4th or as of January 8th or as of March 18th or whatever the date is, right? So income statements will tell you the full story over a period of time, but a balance sheet is only going to show you what it looks like as of that day, which could change from day to day.
I think that's a very good point about balance sheets, as a point in time, and income statements are over a period of time that things can change on a day-to-day basis. But let's go back to the beginning, that you've seen a lot of companies that were succeeding that have failed, and a lot of failing companies succeed. Maybe you can walk through some pitfalls of companies or some decisions that caused the company to fail.
Yeah, sure. So, again, if we talk about accounts receivable and inventory that we just went through, there's definitely some common pitfalls, as you said, right? So from inventory, we once had a high-end restaurant that did very well, and they sold steak and shrimp, and they got a great deal on steak and shrimp. And I don't remember the exact numbers, but let's say that they sold, 1,000 steaks per month. Well, they were offered a great deal if they bought 5,000. Well, so as you know, and the meat industry and shrimp and seafood and stuff like that, it spoils, right? And so they weren't able to sell that, right? So they ended up paying a lot more for this inventory. They got a better deal per steak, but they ended up having to throw away a whole bunch of it because it spoiled and they weren't able to sell it. So it took them a long time to get back to where they were, and they had to cut some staff, make some changes. But they just didn't understand, it seemed like a great deal, but it wasn't, because they weren't going to be able to sell it, and the meat and the shrimp actually ended up spoiling, and so they ended up having to throw it away. And then another company from the inventory side, right, was a technology company, and they bought and sold computers and phones and things like that. And so they were in business for 12, 15 years and doing very well. And they thought they had a great deal, right? And so somebody approached them, offered them a whole bunch of computers to buy, and they thought they were getting a great deal on this. And so it was just too many, right? Because in the technology world, things change quickly, and they underestimated that. And that the computers that they bought were really obsolete in a year. There was a new model, there was new technology, and so they ended up having a whole bunch of inventory left over and had to sell them at a discount. So they ended up losing a lot of money, and that company actually ended up going out of business. So from the inventory side, you just really need to know what your true inventory levels are. You need to know what you can sell, what is worth money, what changes quickly, right? Know your industry. Does it spoil? Does the technology change? Will there always be demand for it? Because inventory is really only as good. It's only a good deal, right, if you can sell that inventory.
I think that's a very good point. I think we also saw sometimes during COVID where, they ramped up their inventory, and, they weren't able to sell it as quickly as they thought they were. And to your point, the inventory becomes obsolete. So I think those are really good examples on inventory. Do you have an example with accounts receivable?
Yeah. So one example, I wouldn't say it's a great story, but we had a granite company once that used to supply granite for contractors doing kitchens and home buildings and things like that. And so this company gave one contractor about $400,000 worth of granite that cost them $300,000. So on their balance sheet, it looked like they showed, or their income statement, it looked like they were making $100,000 on this. So when the contractor was halfway done, they came back to this company and said, we ran out of money. We need more granite, but we need we can't pay you yet. We'll pay you after the job is done. So the first 400,000 was still owed to them. It was a receivable that they hadn't collected, right? And so now they came back to them and said, we need more money, more granite to continue to complete the job. And so this company, what they did was they ended up giving them another $200,000 worth of granite, which increased that receivable now to 600,000. So the contractor actually ended up not completing the job, going out of business, and filing bankruptcy. So when you look at a borrower's balance sheet, it looked like they were very profitable on this, right? They sold $600,000 worth of granite. They were making about $150,000 on that. But in actuality, they never got paid for any of that, right? Because the contractor went out of business and filed bankruptcy. And so they spent a lot of time digging out of that hole, right? They ended up losing about $450,000 on that because the receivable is only as good as whether or not it's collectible, right? Like, so again, on paper, it may look like you're profitable. On that income statement, it looked like they're profitable, but you can't pay expenses and bills with IOUs, and you need to be able to collect the receivables. So in that case, not collecting the receivables put them in a very tough position, and they ended up losing a lot of money on that deal.
So in those cases where a company can't generate their own cash flow or just need money, what are some options for them? And maybe just touch on some advantages and disadvantages of each.
Yeah, so there's a lot of different options out there. It depends on the company and the owners and what they really want to do. They can change the way they operate. They can collect receivables faster. They can pay payables in a different time period or negotiate with their suppliers. They can borrow from friends. They can go to factoring companies. They can get equity investors. But a lot of times we'll see them come to a bank for a loan.
And since we're a bank, can we focus on that one? How does access to a bank loan help a client with cash flow, or in our terms, we call it a working capital line of credit?
Yeah, so the working cap, that's a good point. So the working capital line of credit is really the main product that's used for cash flow. It's more or less a bridge the gap type product, right? So in the case we discussed earlier with the pencils, a company can borrow from the bank to buy more inventory to sell if they don't have the cash yet and they have more demand. Or they can use the bank's line of credit to make payments to the suppliers or to pay expenses or things like that while they wait for receivables to come in. So it is really that bridge the gap, that in between when they need money and they're waiting to get more working capital coming in. So they sell inventory, they collect the receivables, they pay the line of credit down, they borrow back from the line of credit, and that kind of cycle keeps going. And it really works almost like a very large credit card in a way.
So effectively, banks help small businesses with a working capital line because of timing and cash flow, right? It's all timing of when you collect on your receivables, maybe when you pay your payables, buying inventory. It all kind of intertwines, but it's a timing issue. Just a little bit about how a working capital line of credit is typically secured for a bank?
Yeah, so banks like to see collateral coverage on their lines of credit. And usually the collateral on that line of credit will be accounts receivable or inventory. And really banks are going to look and make sure that a company has enough inventory or accounts receivable to kind of be above what that line of credit amount is. And banks usually apply what's called an advance rate against those accounts receivable and inventory, because in a liquidation scenario, we're not used to selling the inventory. We don't have the relationships with the customers. So usually those accounts receivable and inventory are discounted a little bit as we give the line of credit.
And how do banks typically underwrite those commercial lines of credit? Go
ahead.
Well, what kind of like financials or what would we be looking at?
Sure. So when banks are looking at whether a company is going to get a line of credit, there's a lot of different variables that go into it. But just from the financial standpoint, we're typically looking at the last 2 to 3 years of financial statements that we'll collect, and we'll look at their ability to pay on an ongoing basis. So we're going to underwrite and do some financial analysis on the historical figures of the company and use that to determine if we think, all things equal, if that continued in the future, would they be able to support the line of credit that we gave them?
Well, thank you for your perspective on cash flow and working capital lines of credit, balance sheets, income statements, how they're all intertwined. And I want to thank all of our listeners as we discuss cash flow. If you have any additional questions, please reach out to your relationship manager here at CIBC to assist. Thank you.
CIBC Bank USA, member FDIC, equal housing lender, NMLS number 619817. All consumer and commercial banking products and services are subject to credit and approval. Investment products offered are not FDIC insured, may lose value, and are not bank guaranteed. To the extent that information contained herein is derived from third-party sources, although we believe the sources to be reliable, we cannot guarantee their accuracy. Guests from CIBC Bank USA are not paid for their participation. The CIBC logo is a registered trademark of CIBC used under license. Copyright 2025 CIBC Bank USA.